Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, July the 25th. I want to take just a brief minute to discuss what markets did last week. And boy, it was not a great week to be in the S&P 500 last week, as that broader index was off 1.97% on the week. The mid-cap index, as measured by the S&P 400, was only off 18 basis points, or 0.18%. And the small caps, as measured by the S&P 600, were actually up 2.3%. So bucking the trend of what we've seen so far year to date, or at least through the second quarter of this year, that large was the only game in town and the place that you had to be in, specifically large cap growth. And as we headed into last week, one of the things that we've been talking about seeing is possibly seeing a rotation from some of these winners to these losers. And that's what's causing a lot of this volatility that you're seeing in the index level at the high level. When you pull up the news, and for example, if you were to pull up, and yesterday was a heavy selling day in the market, the NASDAQ was down over 3% off of Alphabet and Tesla's earnings that were perceived as disappointments, at least Tesla's for sure. And so you're seeing a lot of selling in the winners. But what you're seeing is not selling across the broad index and saying everyone getting out. As you're seeing what's happening is you're selling the winners of this year, and you're buying the downbeaten stocks that haven't performed so far year to date or fell back in the second quarter of this year. And those are the ones that are coming up. So yesterday you have the S&P down about 2% on the day, but the equal weight was down half of that, showing you that there is opportunity and you're seeing an underlying trend. Now, why you see the index level as a whole go down worse than the average stock is because, remember, the index is market cap weighted, and the top 5 market cap names make up 30% of the S&P 500's market cap weighted index, so influence very much what that index does on a day-to-day basis. So you're seeing the selling of those winners and buying the average stock. Now, why did small and mid caps outperform last week? We're going to touch on that for just a brief minute, and then we're going to talk about our forecast for what we see moving forward. But why small and mid caps are outperforming is off of the backs of the CPI report for the month of June. So we've had 3 straight months of falling inflation reports that we've gotten. It's given investors, they've priced in a 93% chance that the Federal Reserve cuts rates in September. They meet next week on the 30th and 31st. At River Place, we believe they should be cutting when they meet on the 31st. But we'll talk about that in just a brief minute. But the reason why small and mid caps are outperforming is A, they haven't done much year to date. The small caps were actually negative year to date until July and until the CPI report that we got. And what that does is, with the interest rates coming down, small and mid-cap companies are more reliant on bank lending than they are on the capital market lending, where they can go out and issue bonds into the bond market. So what that does is that allows the margins, just by the rates coming down, the margins to increase in these small and mid-cap companies. And if you remember me talking a couple months ago, the mid-cap index was trading at 14 times forward earnings. The S&P 500 right now is trading at 21, 22 times forward earnings. So much of a discount to the S&P 500. Now, what's causing this has been earnings for your big cap techs where they weren't quite up to snuff, or the expectations for the next quarter were not as good, but we're starting to see some anecdotal signs of slowing in the U.S. economy. We did get a GDP report today of Q2 GDP of 2.8%. However, 1% of that 2.8% was inventory buildup, and a lot of the other 1.8% that you would have on top of that is government spending through the various programs, the Infrastructure Act, the CHIPS Act, and the Inflation Reduction Act. So you have that infusion, so it looks great on the surface, but jobless claims are starting to tick up, the consumer's starting to pull back, savings rates are declining, and wages are not going up as high as they have been. So the Fed has this dual mandate where they have to maximize employment and keep costs under control. Well, it looks like the risk now is not costs increasing anymore, it's to the labor market falling apart. So it's going to be important to see how the Federal Reserve plays this out for the remainder of the year and if they can, in fact, navigate a soft landing. So if you're seeing signs of slowing around you, you're not alone, and it's okay. But understand that the Fed is poised to cut rates in September, and you have these catalysts of productivity with AI and things along those lines, as well as onshoring, that are going to continue to keep the U.S. economy moving forward. So what we would like to see is continuing this broadening out. And what I'll end on is last quarter, the equal weight S&P 500 for the second quarter of this year was actually negative, barely negative and flat, while the S&P 500 index was up around 4% for the quarter. So the average stock really didn't do anything or was down last quarter. That's how narrow the market got. And so while we're seeing the broadening out, you're going to see the selling of the winners to buy those that have been more forgotten about. So continue to see that trend happening. And if you have questions about how to position your portfolio or ways in which we can help you navigate this time, give us a call. We'd love the opportunity to speak to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.